Good afternoon, everybody. I want to begin by thanking my warm-up act, Jim Lyday. Thank you for doing that. So Mike Barton, World Insurance. We are one of the nation's largest insurance brokers, and I help lead that organization. As Jim had mentioned, what I'm going to do today is talk about health insurance. But in particular, I'm going to talk about the escalating cost of health insurance and the impact that has on all of our plans. So aren't you lucky? You got to talk about retirement plan governance and compliance and right into health insurance. So what I wanted to begin with is to talk a little bit about our history here in America with healthcare. So, and like Jim, there's going to be audience participation in this show. So everybody get ready. So the first thing is I'm going to start our little time frame in 1980s, and I'm going to bring it all the way up to 2030. In the late 80s, early 70s, we had a thing called a schedule of benefits. Anybody remember what a schedule of benefits is? Oh, we have a couple people. Ron knows. So Ron and I are of a certain category and age where we remember those things. So what that was a schedule that said, hey, if you go to the doctor, your benefits are going to pay you $100. Or if you get admitted, it'll pay $1,500 per day, something like that. Here's the trick question for everybody in the room. What was the rate of medical inflation in the era of schedule of benefits? It's a trick question. Anyone? Oh, that's a horrible answer. So no, the right answer is zero. Medical inflation was zero when it was a schedule of benefits. Whether you got that benefit in 1978, 1979, 1980, it was a flat dollar amount and it was fixed. So think about where we're at today, you guys, where health insurance is X 10% on a gigantic number. And way back in the 70s and 80s, before we fixed it, before we as a society fixed it, it was 0%. So I just mentioned that wasn't good enough for us. Hence the introduction of managed care. What happened with managed care, everybody? You had networks. You had things like deductibles, and co-insurances, and co-pays, and those came into being. That was the solution to the problem that really wasn't a very big problem looking back on it 30 years ago. So when we did this, let's go forward to the 90s now. We had this thing called HMOs that came into play. Anybody remember good old-fashioned HMOs? All right, so remember these. This is 100% co-insurance, $5 copay, go see somebody in the network. You had a primary care physician. He or she was responsible for referring you to a specialist or admitting you to a hospital. How did we, as Americans, feel about HMOs? Yeah, that kind of blew up. Right? So we didn't like that. We didn't like somebody steering and controlling our care. You know who else didn't like it? Providers. Providers didn't like it at all. The key element in HMOs back in those days was a thing called capitation. And what that meant is that provider, if I subscribed, I made them my primary care physician, that private provider would probably get $100 per month to manage all of my care. Well, what happens if I happen to be sick? And I require a lot of care, or a lot of tests, or a lot of labs, or a lot of pharmacy, and that doctor only got $100. That's all they get, capitated. All of the risk got transferred to the provider. They didn't like that. They lost money. So here's what happened. 0% medical inflation, back with capitated HMOs, around 4%. So costs went up 4%. At that time was largely consistent with CPI, but still not as good as what we had in the 80s. Now let's fast forward and go to the 2000s. Because we as a society revolted against capitated HMOs, these things called point of service plans came into play, where you can go in network, you can go out of network, you can have an open access point of service plan, where you don't have to get a referral from a primary care in order to go see a specialist. Sounded like the perfect solution. Except that when you look at medical inflation, it went up. So the cost went up and the rate of increase also went up. So for those of us who are not math majors in the room, to go from 4% to a 6% rate of medical inflation, that is not a 2% increase. That is a 50% increase in the rate of cost escalation. It's a big deal. So do you get a sense where I'm headed with this? We're getting worse and worse as a society. But wait, there's more. What happened with quote unquote Obamacare? We had to fix the problem, right? What was the fix? Everybody in the room should know this because we're all in these plans today. What was the fix? High deductible plans, right? Remember this? So we're going to have these things called a high deductible plan. We're all going to share in the risk associated with our own care. If I have a high deductible, theoretically, then I'm going to be a better shopper of care because it's my money I'm spending. And as a consequence of that, the rate of demand on care will come down. Costs will go down. The rate of inflation will go down. Let me ask you a question. Last time any of you went to see a doctor, did you know what the cost of your service was before you received care? You do not. You don't know until literally 45 days after when you get this thing in the mail called an explanation of benefits, which, by the way, are so confusing that the explanations require an explanation. So you cannot be a good purchaser of healthcare if you don't know what the friggin' price is. So what happened is, again, 0, 4, 6, now it's 8. Now it's 8. Then COVID happens, right? So what happened, for me, I break COVID into 2 phases, phase 1, phase 2, when it first happened, then when it came back. In phase 1, when COVID first came out, what happened to all of us? Did we go see a doctor and get routine preventative care or maintenance when COVID just came out? Anybody? Why didn't we do that? That's where sick people were at, you guys. So that was the last place any one of us were going. So 2 things occurred. And by the way, we've measured it. 2 things occurred. First thing that occurred was a phenomenal windfall for health insurance companies. If we pay a premium and then we don't see a doctor, what happens to them? They make way more money. It was a financial windfall for health insurers everywhere. The second thing that happened, we didn't go see the doctor. There was a rebound effect on the cost of care in America. We've studied it. So you have this period of time where none of us are going to see a doctor. Did all of us get well during that period of time, or did whatever disease state that existed in our body continue to fester and get worse during that period of time in which we don't receive care? It's not the former, it's the latter. So what happened is we got worse. Our healthcare costs went up a lot because we did not receive the care that we needed. So the good news is, by the way, before I go any further, anybody here work for a health insurance company? Outstanding. We'll have a lot of fun with this. So what happened is when we got sick and we went back to see the doctor, and guess what? We were sicker. All of us were sicker. So all of that money that they made, they lost. So what happens if you're an insurance company and you are for profit, traded on the New York Stock Exchange? Do not get confused by anybody who says we are not for profit healthcare. They're the most profitable not for profits on the planet. So trend went up. They jacked up the rates. So what didn't happen is in the wave 1 of COVID, when they have all the premium, no claims, theoretically, premiums should have gone down. Did any of you get a rate decrease during that period? You did not. You sure as heck got a rate increase after the claims payback, did you not? So I'm going to spend a lot of time today talking about what happens inside the mechanics of your health insurance renewal. Don't worry, we're going to have fun with it. I'm an old underwriter. I spent 12 years at United Healthcare. I was the guy who helped build the underwriting model that defrauded you out of money. So I'm the best person to talk about how you can defeat it. So, but I will say this. When you're here, and now you guys are all looking ahead, and trend is still 10-ish% right this second. It's 10-ish% of a gigantic number, right? Just, you don't have to answer. Think about the cost of your family coverage on your medical plan. Just look at the number, the rate. It's probably the equivalent of a mortgage on a 3-bedroom house. Think about that. As an American, people are making decisions of having a home or having health insurance. It becomes guns or butter. That's awful. We're going to talk a little bit about how you defeat that. That's what the big setup is for. I'm not going to cover these slides. So what I wanted to depict for you is the cost of insurance over this particular period of time. I think you get it, right? 2015, we break up things into units, cost per employee per year, which is the composite of your employee and all of the belly buttons that they cover underneath them. Was about $6,700 in 2015. It goes quite a bit more, almost $10,000 in 2020. In 2025, it's going to be close to $15,000. That's a lot. If you pay 2/3 of that, then you're going to pay $10,000. It's a lot when you think about your overall total reward mix and the amount of investment that you have to make in one piece of that that's going up. Also, you can have this thing called a health plan that is supposed to be the jewel in the recruitment, retention, and motivation strategy. How do your employees feel at open enrollment time when you deliver the 2 messages that everybody gets every year? Which is this. Hey, good news, everybody. This is our now an open enrollment meeting. Your rates are going up and your benefits are going down. Enjoy your health plan. That's everybody's message. We're all tired of it. Here's the thing that I think is really important for you guys to sneak a peek at, and I've helped. I've put a nice dotted red circle around it with an arrow so you can't miss it. That is the cost of pharmacy. You cannot watch the news, you cannot watch TV and see ads and not understand that pharmacology is creeping up among all of us. All of us. That cost, that $4,700, is just pharmacy. It's crowding out everything else. It's crowding out physician costs. It's crowding out outpatient facility costs. At some point in the very near future, it's going to be half of your overall healthcare spend. Just pharmacy. So you guys, it's important, right? I'm going to pick on just a couple of drugs. I'm not going to ask anyone to answer this question, but there's this thing called hemophilia. I work with many groups. Our client advisors work with many groups. Hemophilia is a fairly rare disease. The incidence rate is, 1 in 200,000. But if you have a hemophiliac in your group that you have to insure, it's a bad day for you as an employer. It's a terrible dread disease for anyone afflicted with it. But essentially, it means that you have to spend $18,000 a month on a drug. All that drug does, it's a clotting agent. So it makes sure that if you get a cut, you don't bleed to death. That's just a clotting agent, $18,000 a month, every month, forever, because the disease never goes away. But that's the good news. The bad news is, what if you have an event, a cut, you have to go to the hospital? You're going to be there at least 3 or 4 days because they have to stabilize you. That's going to be another $50,000. So somebody with hemophilia typically costs a plan sponsor somewhere between $300,000 and $400,000 a year, every year, and they never come off. That's expensive. The pharmaceutical industry has discovered a way around that. Essentially, it's a drug. It doesn't cure it, doesn't make it go away, but it arrests the process through RNA reengineering. It's fantastic. It's a miracle drug. That miracle drug is now out of stage 3 clinical trials. That miracle drug costs $2 million. You going to cover that in your plan? What's the risk? $2 million. So it doesn't have to be a $2 million drug. I think all of us have heard about cures, also, not cures, helpful antidotes for coming out of stage 3 clinical trials for things like Alzheimer's. All of us are impacted by Alzheimer's. It'd be incredibly rare to have not known anybody in your family affected by Alzheimer's. That drug isn't going to cost $2 million. Anybody think it's going to be cheap? That drug will likely go on your plan. So remember the last page where I showed you the cost of pharmacy? $4,700 per employee per year? That's a small number. It's going to get bigger quickly. What about drugs like Ozempic, Wegovy, Eli Lilly just announced they've come out with their version of it. Costs 20% less and is theoretically 20% more effective. You gonna cover those? Wild debate on these things. And it's a healthy debate. But it just underscores the problem that we have a demand issue, we have a cost issue, and it's complicated by the fact that we have these things called insurance carriers, and there's only 4 of them in America. And they control the delivery and the cost associated with all of this. So when I tend to think about problems, you guys, I think about stuff that you can fix and stuff you can't fix. The stuff we can't fix, don't spend any time on. Nobody in this room is going to figure out our aging population. Nobody in this room is going to determine how we deal with advances in pharmacology. Everybody's tried tort reform. There's a reason why it never goes anywhere. Deeply entrenched political lobbies, which ties into tort reform. And then, of course, patent law infringements. And really what I mean by that is the big pharmaceutical companies for the drugs that I just mentioned should be a 7-year patent. What happens at the end of 7 years these days? They reapply. They get a continuation of the patent. So there's no such thing as patent law. They never come off brand. It never goes to a generic. So those are things that we can't control. Those are things we should control politically, but we don't. Here's what you can control. You can modernize your plan design. I'm going to talk a little bit about what that is. You can be better at identifying carrier waste and profit. I'm going to talk a little bit about what that is. You should always be thinking about your contribution strategies to make sure that your investment in your total reward strategy is most effective for your key talent, program funding, and demand management, the rate at which we all consume healthcare. I mentioned that there are only 4 national health insurers. There used to be 5. What happened to Humana? That's right. Pause up. Pause up. We can't do it anymore. We can make more money on Medicare. We're only going to do that. You guys, I'm going to take you back to high school. I have 2 kids in high school, so I know that they're actually studying this. So macroeconomics 101. If there are only 4 suppliers for a product in any industry, who has leverage? The buyer or the seller? Seller. In America, I call this a government-sanctioned oligopoly. That means they've got all of us leveraged. And if you don't believe that, this is United Healthcare, my old alma mater. At the point that I did this slide, they were trading at $458. And the last time Brent and I did the show, he informed me it was more like $525. Think about that. Healthcare company trading at $525. That's insane. We're all paying for that. Every one of us. And again, I mentioned I'm an old underwriter. It used to be that there was some integrity in the process. And here's what I mean by that. The process used to be, I take your claims experience, what you actually paid, right? And then I would trend it forward for medical inflation because I got to move it forward to the next contract period. I'd take my expenses, I would put it on top, that's your new premium. And we would show you all of those numbers through real life exhibits. So I felt pretty good about what I used to do as an underwriter. But the world changed. As these companies got bigger and bigger and bigger, if you're a publicly traded company, and I've worked for a number of them, you have one job. What's your one job in a publicly traded company, everybody? Earnings per share. Earnings per share has got to go up. That means you got to have margin expansion, not compression. So the only way to do that if you're a healthcare insurer, because remember there's only 4, they've already split up the universe. The only thing they ever do all day, every day is just trade accounts. It goes from Cigna to UHC to Aetna, back to Blue Cross, and they trade, but none of them get bigger. They still got to grow. That means it got to come from you. It's got to come from you. They don't ever win in market share anymore. So now, when you get a renewal, it's not like the days when I used to run them up. It's different. It's basically based in fiction. You will get things that say, you had a claim, Mike, that looks like it could be something more serious at some point in the future. We're going to add that to your renewal. Well, think about that. It hasn't happened. Didn't happen. So they're making something up and putting it in my renewal. I may not ever have that problem. I may not be employed by that employer. You can't put that in the renewal. Yet in every one of your renewals, every one of them, you're all getting this today. You may not know it, but I promise you that is occurring. That's a real big problem. The Department of Insurance got wind of this because somebody told them. And in the state of Arizona, where I used to be an underwriter, I was the one who told them. I still remember the Department of Insurance commissioner's name. Her name was Mary Butterfield. I went to Mary. I said, they're lying. They're all lying. Gave her tons of information. When you used to get your renewal, it was an exhibit-based renewal. It used to say renewal justification. Everybody's did. I was there. When you get a renewal, it will no longer say justification. Justification is a legal term meaning that it's based in fact. Now, every single one of your renewals, if you actually get one, and many of you won't, it's going to say renewal illustration. Why do you think it says illustration? It's artwork. It's artwork. And there's fat built into all of your renewals. And I'm going to show you where. That's going to be the fun part. I'm going to give you the inside baseball on this today. So the thing that you need to know that every underwriter, whether it's at Cigna, United Healthcare, Blue Cross, Aetna, they have a job, just like every one of you have a job. And they have to look at their book of renewals for every month of the year. Their January, it's their February, it's their March renewals. I was one of those guys. And my boss would come sit next to me and he'd say, hey, Mike, I know you're working on your February renewals. I need you to get an average of 14% on your February renewals. Okay. Well, how do I do that if I'm actually doing a fair underwriting? The underwriting is what it is. I can only deliver that to my boss if I'm making stuff up so that I'm solving for X and X is 14%. That's how it really works. So let's talk about that. This is the fun part. So this is an actual renewal for an actual client, one of my clients, actually. The underwriter is Aetna. It's going to sound like I'm making fun of Aetna. I'm not. I actually am proud of Aetna. They were one of the few companies who actually sent a renewal exhibit. Many carriers don't even bother with it anymore. You get old rates, new rates, your changes in demographics, changes in plan design, changes in trend. We use them as factors, so we multiply it and get you from your old rate to your new rate. So again, I give them a lot of credit for even pulling this together. But let's just pick it apart piece by piece. And so you can see what's going on inside the renewal. So the first thing that you should just absorb. When you look at this, is this easy to understand? Looks like calculus, man. So there's a lot of categories. There's a lot of lines. There's 3 columns. There's 18 rows. Here's what you need to know. This is page 1, and I had to cut it in half so it would fit into a slide. It's real. So let's start at the very beginning. Line number 1, I didn't number it. The good folks at Aetna numbered it. Line number 1, it says incurred claims. Does that say paid claims or does that say incurred claims? Okay, why wouldn't they show me what paid claims are? Line number 1. Line 1, line number 1. Anytime somebody says that they've incurred claims, they said, hey, I got your paid claims. I'm not going to tell you what those are. I'm going to incur it for a factor because I know it was incurred at some earlier date and some more claims can come in. I don't know what those are. I'm going to add a value to that and I'm going to tack it on your paid claims. Anybody want to guess what the value of this incurral is? It's about 25% on line 1. Line 1, they've increased your costs 25%. So again, I have helpfully put a nice little red X on that one. Red and X means double bad. So let's keep going. I'm not going to go through all of the areas here, but let's go for a change or adjustment in the change of network. And you can see they've multiplied that by 1.2054%, so 2.5%. What does that mean? Anyone? Jim's going to give a great present for anybody who gets this one right. What? Profit. They're all profit. But what are they trying to tell us? A little bit, yes. So when someone says adjustment for a change in, where am I? Up here. Change in network. What they're saying is the providers that we contract in your area asked for more money, right? We had to give it to them. And they're saying that's worth 2.5%. Okay, I buy it. That's real. That happens all the time. Here's why I don't buy it. You see this number down here? Also helpfully circled in red. It says 9.9%. That's medical inflation. That includes the change in network. It is. That's what trend is. So they've just added it again in the form of 2.5%. Let's keep going. 1.06%. This is a change or adjustment in the demographics, the age, gender makeup of the groups. All right. So there's two pieces to every renewal, you guys. There's your own experience, and then there's blending with manual. Your demographics are already the people who incurred the claims. You don't need to make a change. Unless your demographics change, like people left and more people came on and they were older or sicker or whatever, then you would have that. In this group, I happen to know there was no such change. So this is now, we're on line number 3. 24%, 2.5%, 6%. I'm at 30% above what my base number actually is. We're not even halfway done. This one is my favorite, underwriting adjustment. 2.5%, 2.4%. So this is, remember what I said? I'm going to pick on you. You're my underwriter, and the boss said I got to get 14. I came up short. I got to add a couple more. That's what that is. So it's a real problem. So again, this is just the experience workup of your renewals. And by the way, this is how it works, you guys. Page 2 is the manual. So what every insurance company does, they say, you've got your own experience, but I don't trust it. You're just a small little company. I'm Aetna, right? I insure 40 million people. I'm going to use my book of business. That's more statistically credible. Could be theoretically true. I wonder, though, if the group is large enough to be statistically credible, why would you blend it all? I will say this. Remember, let's go back. This is my incurred claims of 144, right? And I said that they're inflating that by 25%. So let's just say the real paid claim number is 110, just for giggles. Look at the manual number that they're blending me with. 110 versus 250. Any percentage of pushing those numbers together makes it go up even further. So now we got a real problem, because now Aetna has said, we don't trust your claims experience, even though we inflated it to death. That wasn't enough. We're going to use our own book of business, but we think our book of business is running 200% of yours, and we want to use more of that than your own experience. This is called blending with manual. It's a gigantic area of cheating. So big problem. And then the other thing that's really funny, large claim adjustments. Large claims are what drive your plan costs, you guys. In this renewal illustration, they admit it. They said, well, you don't got any large claims. So let's just examine the facts. My claims are low. They've inflated them. Apparently that wasn't enough. We got to blend it with manual, inflate it still further. And they're already admitting the biggest driver of cost are large claims. And they're literally saying, we got none of those. So you look at this and you go, what is going on with my renewal? So when you go back to my first exhibit where I talked about the rate of escalation in healthcare in America, this is it. This is the culprit. This is the things that all of us as consumers and buyers of healthcare and plan sponsors, we need to be vigilant about this and know what's going on. And magically, remember on the previous slide, 9.9%, right? What an amazing coincidence. They've done this calculation, and again, it came out at 9.9%. All of this 2 pages of numbers, and it magically came in at 9.9%. So it's a head fake. The whole thing is a head fake. For this particular group, the number wasn't 10%. That was the renewal that Aetna wanted. It went down to -10. The delta between +10 and -10 is 20%. Imagine the value of your plans if you were saving 20% every year rather than going up 20% every year. Your insurance might be affordable. Guess what? The benefits might be richer. Guess what? Your people might like it better. They might retain more. They might be more productive or engaged. They might not roll their eyes at open enrollment meetings and say, oh, here we go again. This is our job. All of us need to be aware of that. I'm going to skip that slide. What I want to talk about is, what do you do? How do you fix the problem? Apart from just being aware of what's going on in this transaction process, you have to be able to solve the problem. And the problem for most of us is just demand on care. Thank you. I'm getting the 10-minute warning. So the one thing that I would share with you guys is we do this for ourselves. At my company, we got about 3,000 employees, got about 2,500 of them on the plan. We were living the same dream as everyone else. We were fully insured with United Healthcare, my alma mater. We got a 25% increase. Everybody about blacks out. And we figure out we got to do something different. We were a terrible group. And I'll show you what a terrible group looks like from a risk standpoint. Our age gender factor, 1.18, means that we were 18% worse than norm. Our level of physician engagement, and physician engagement is the rate at which you see doctors for preventative screenings that are age gender appropriate. The resting rate for most companies in America is 40%. We were half at that. We stunk. We were awful. And then if you looked at our cost per employee, it was around $13,000. Not great. So we weren't a good candidate if you're just looking at the risk of the group. We said, we got to do something. We've got a burning platform. We're going to attack it. The way that we attacked it is we looked at our funding so that we could strip out a lot of that carrier waste and profit and gain control. But we didn't stop there. We had to pipe in better demand management. So when people had diabetes or musculoskeletal or cancer or fertility, maternity issues or mental health issues, we were better prepared to deal with that. So we traded out okay care for phenomenal care at each step of the healthcare delivery chain. So for us, it meant swapping out vendors. I would say, you guys, and you'll get this checklist, so John or Brent will send you this checklist, but there's 10 things as an employee, just be aware of. Just be aware of as a good consumer. Demand your renewal illustration. Demand it. By the way, you're owed it by law. You're owed it by law. What you get by law is largely up to the carrier, but they owe you something. Number two, everybody, it sounds obvious, age, gender appropriate screenings. This is mammography for women, colorectal, prostate, and then immunizations for your kids. If you guys just do that, you will be surprised at how many things that you can identify early before they become bigger problems late. And the best way to do that is to give people time to do it away from work and to provide incentives when they do so. Number three, use benefit design to influence the rate or usage of high-performing physicians. I'm sure you guys all know this, but physicians are stacked, ranked, and scored all across America. Physicians are stacked, ranked, and hospitals and outpatient facilities are stacked, ranked, and scored all across America. CMS, Health Grades, Blue Book, all of the data is out there. Do you guys know the rate at which most of us utilize a high-performing physician? And a high-performing physician, without thinking about it too much, is just someone who has better adherence to evidence-based medicine practices, lower complication, lower readmission rates, just better outcomes. What is the rate that each of us actually sees a high-performing physician in America today? 10? That's a good guess. Anybody else? 26% of the time. A quarter of the time, we are seeing a high-performing physician. Physicians are like any other business, any other vertical, any other job. Some people are better than others. Where it's your healthcare, the difference between seeing a high-performing physician or facility or provider versus non-performing is about 18%. And the 18% isn't because it costs less. It's because the care was better and it made you healthier. Everybody should know this. The tools exist. You need to be talking to your advisors and your carriers about it. I talked about pharmacy. Everybody's got to be looking at their pharmaceutical costs. Pharmacy benefit managers play games with your formularies, what drugs are in formulary, what firms are out of formulary, what are the rebates, what's the AWP discount, all that kind of nun stuff. You'll never understand it. Don't try, but you should hire somebody who knows those contracts cold and knows what a most favored nation's contract looks like, compare it with what you get, and make sure you're getting true value. I'm not going to spend a lot of time talking about genomic testing. This is going to be coming up more and more. You guys are going to hear more and more about this genomic testing around what is the right drug for you. Has anybody gone to the doctor and the doctor said, hey, let's try this drug first? Does this ever happen to anybody? And then we'll try another one, then we'll try another one. The reason why we're trying drugs is because genomic testing has not occurred. And the doctor is making a best guess based on the symptoms that you present. In the presence of genomic testing, you don't have to guess. When we try drugs based on what the provider tells us, they're guessing at our rate of metabolism. Look around the room. We all have different metabolisms. I could be prescribed a drug that can metabolize out of my system before it had any clinical impact. This is something you are all going to learn more about in the coming months. The payoff here could be as much as 30%. It's a big deal. Identify Medicare eligibles in your population. We all have them. In my company, we got a ton of them. Everybody talks about this. It's complicated. The government really, really frowns on people who try to kick Medicare eligibles into Medicare. Why do you think that is? They don't want the risk either. They don't want the risk either. They would much rather corporate America pay for that. So if you're going to communicate anything, you have to communicate fairly and evenly to everybody all the time. You cannot target one population. Introduce care navigation partners into your vendor lineup. Whether you're fully insured or self-funded or something in between, you need a friend in the foxhole who can help guide you through a very complicated healthcare system and who can tell you who the best providers are so that you can get better care, so that you can make the best use of your benefit design. Super important. Adopt best-in-class point solutions for the major disease states that we know are prevalent in America today: cancer, diabetes, hypertension, musculoskeletal, fertility. It's in everybody's group. The only question is the rate at which it is in your group. There are better solutions out there than that which is being provided by carriers today. Entire cottage industries. Re-examine your plan designs, price points, and contribution strategies in light of your overall total reward strategy. And then the last thing I would tell you is don't assume that the advisor that you work with is an underwriter. Don't assume the advisor that you work with is an actuary. The vast majority are not. There are 700,000 licensed insurance agents in America today. 700,000. The rate at which any of those actually were an underwriter or an actuary is preposterously small. Less than 1/2 of 1%. Less than 1/2 of 1%. Given what's at stake, you need an expert to be your friend in the foxhole. What I wanted to do is to give you a little ray of hope. So Brent, if you wouldn't mind pulling up our application. So what we've done is we've built an application that helps employers like you do exactly what I just did. Whether you're fully insured or self-funded, how do you assess your own program? What is the right number? What should it be? We've plugged in a couple of things. ABC company, make it $10,000, Brent, if you wouldn't mind. Cost per employee per year. Make it 120 eligibles and 100 enrolled. Let's assume that we're fully insured. I don't have any claims data because the carrier's awful. They didn't give me any. So, and I click next. So if you're fully insured and you're trying to say, how do I know if the carrier is cheating me? Here's how you know. All of that underwriting, all of that math that I just walked you through, we've built it into an app so that you can test it too. And in fact, one better, you can improve upon it. You can say, well, what if? I know I'm fully insured, but what if I add care navigation? What if I added a best-in-class disease management program for diabetes and hypertension? Let's click yes on both of those. Let's go down, scroll down a little bit further if you wouldn't mind, Brent, and go to, how about incentivized plan design? All right, so this is where you actually put benefits that are improved in front of employees who do the homework to find a high-performing position. And then let's carve out the pharmacy because we know that's a problem, and then reinsurance. And then scroll back up. So two things. On this particular analysis, if I'm fully insured, it's saying, hey, here's my cost today, right? Remember, I have 100 employees. I said the cost per employee per year is 10,000. That's $1 million. But what if I started stripping out some of that carrier profit? And then what if I weaved in some best-in-class disease management? What's the value of that? Well, you can see that it's worth about $250,000. And so that's the financial impact. The clinical impact is just by doing a few things, I think I can make my people 42% healthier. And that's how you check the math. Takes that long. Click submit really quick, and then we'll just go right to the report and I will conclude. Go to the 5-year savings analysis if you wouldn't mind. So the question becomes, over time, what's the value of that to you? Well, it's a lot. In this particular instance, for a 100 life group, it could be up to $5 million over 5 years. It adds up quickly. It adds up quickly. So be looking for opportunities. We mentioned some of the things for you guys to look at. I will conclude with that, and thank you all for your time. I know this is a big investment. Thank you for joining us today.